Disclaimer: this video is created for educational and informational purposes only. It should not be taken as financial, investment, or legal advice. Always conduct your own research or consult a qualified financial professional before making financial decisions. Interest rates. You hear about them everywhere. On the news, in the markets, from your bank. When they go up, people panic. When they go down, investors celebrate. But what are interest rates really? And how can one single number control the price of your home, your job, your savings, and even the entire economy? Welcome to Money Mindset, where money finally makes sense. If you're new here, make sure to like, subscribe, and turn on notifications because we post new videos every day that help you understand how the financial world really works. Let's start simple. An interest rate is basically the price of money. When you borrow money from a bank, a credit card, or even your mortgage, the interest rate is the cost you pay for using that money. And when you save money, the interest rate is what you earn for letting the bank use yours. It sounds small, 2%, 5%, 10%. But this tiny percentage is one of the most powerful forces in the economy. When interest rates are low, borrowing becomes cheap. People take out loans, buy houses, use credit cards, and start businesses. Spending increases, companies hire more workers, and the economy grows. But when interest rates go up, the opposite happens. Borrowing becomes expensive, credit slows down, people spend less, and the economy cools off. It's like the central bank, usually the Federal Reserve or the European Central Bank, is using one lever to speed up or slow down the entire economic engine. Think of interest rates like the thermostat of the economy. When things are too cold, meaning growth is slow or unemployment is high, the central bank lowers rates to warm things up. Money becomes cheaper, spending rises, and businesses expand. But when the economy gets too hot, prices rising too fast, inflation getting out of control, the central bank raises rates to cool it down. Borrowing gets harder, demand slows, and prices stabilize. Now here's where it gets fascinating. Interest rates don't just affect loans, they affect everything. Let's start with housing. When interest rates fall, mortgages get cheaper. More people can afford homes, so demand rises and prices go up. When rates rise, the opposite happens. Fewer buyers, slower sales, and falling prices. That's why housing markets are often the first to react when central banks change rates. But it doesn't stop there. Higher rates also hit the stock market. Think about it. When rates are low, investors don't earn much from saving in the bank, so they move their money into stocks and assets that promise higher returns. But when rates rise, those safe savings accounts and government bonds suddenly look more attractive. So money flows out of stocks, prices drop, and markets cool down. Even your job and salary are connected to interest rates. When rates are low, businesses can borrow cheaply to expand, hiring more people, building more factories, creating more products. But when rates rise, borrowing costs increase. Expansion slows. Hiring freezes. Sometimes, companies even start cutting jobs. That's why rising interest rates can eventually lead to higher unemployment. And then there's inflation, the silent force that eats away at your money's value. Interest rates and inflation are like two sides of the same coin. When inflation is high, meaning prices are rising too fast, central banks raise rates to slow spending. But when inflation is low and the economy is weak, they cut rates to encourage growth. The goal is always balance, enough growth to keep people working, but not so much that prices spiral out of control. Now, let's talk about how central banks actually change interest rates. Contrary to what most people think, they don't control every rate directly. Instead, they set a base rate, the rate at which banks lend money to each other overnight. When that base rate changes, everything else, from mortgages to credit cards to business loans, moves with it. It's like setting the tone for the entire financial system. But there's a psychological side too. Central banks know that their words can move markets as much as their actions. That's why every speech by a Fed chair or ECB president is analyzed word by word. If they hint that rates might rise, investors react instantly. Mortgage lenders adjust their offers. Currencies shift. Stock prices swing. Because in modern finance, perception is almost as powerful as reality. Let's look at a real-world example. During the 2008 financial crisis, the US Federal Reserve slashed interest rates to nearly zero. The goal was simple: make borrowing cheap, so people and businesses would spend again. It worked. The economy slowly recovered. But cheap money also led to massive borrowing, record home prices, and rising asset bubbles. Fast forward to 2022, and inflation suddenly spiked to its highest level in decades. So central banks around the world did the opposite. They raised rates rapidly to cool things down. The result? Housing markets slowed, stock prices dropped, and borrowing became painful again. That's the cycle. Cheap money fuels growth, but risks inflation. Expensive money controls inflation, but slows growth. It's a constant balancing act, and it affects every dollar in your life. Here is something most people don't realize. Interest rates even influence your currency's strength. When a country's rates go up, foreign investors want to earn that higher return, so they buy that country's currency. Demand rises, and the currency strengthens. When rates go down, investors look elsewhere, and the currency weakens. That's why changes in interest rates can shake global trade, import prices, and even tourism. But here's the key takeaway. Interest rates don't just control money. They control behavior. Low rates make people feel optimistic. They spend, borrow, and take risks. High rates make people cautious. They save, hold back, and wait. It's not just an economic tool. It's a psychological one. And because the global economy runs on confidence and credit, that psychology shapes everything from Wall Street to your wallet. So, what can you do with this knowledge? First, pay attention to rate announcements. They're not just headlines. They're signals. When rates are rising, focus on paying off variable rate debt like credit cards and personal loans. When rates are low, it might be a good time to refinance your mortgage or lock in cheaper debt. Second, understand that markets react emotionally to rate changes. Short-term volatility doesn't always reflect long-term value. Stay calm, stay informed, and think long-term. Finally, remember this: the economy isn't just numbers on a screen. It's built on human behavior, confidence, fear, trust, and timing. Interest rates are the invisible hand guiding those emotions, shaping every major decision we make as individuals and societies. So the next time you hear that the central bank raised or cut interest rates, don't just shrug it off. Realize what it means for your job, your savings, your investments, and even the prices at your local grocery store. Because when interest rates move, everything moves. If you found this video helpful, give it a like, subscribe to Money Mindset, and turn on notifications. We post new videos every day to help you understand how money, psychology, and global systems really work, so you can make smarter choices for your future. And tell us in the comments, do you think interest rates have too much power over our lives, or are they necessary to keep balance in the economy? Because in the end, understanding interest rates isn't just about finance. It's about understanding the hidden force that shapes every part of your financial life.